CoreWeave is one of the fastest growing names in the AI cloud and GPU data center space, and its recent IPO has brought it into the spotlight. The company focuses on delivering high performance infrastructure for generative AI and large scale machine learning, making it a specialized alternative to traditional hyperscalers. But despite the explosive revenue growth, CoreWeave carries substantial volatility and execution risk. It's still early in its public market journey. It is unprofitable, and its business model requires enormous ongoing capital investment. That means the stock behaves more like a speculative, high growth AI play than a stable cloud provider. Investors who follow it closely are watching both the long term opportunity and the short term turbulence that comes with rapid expansion. CoreWeave operates in one of the most demanding segments of technology, AI compute. The company builds and manages GPU-optimized cloud infrastructure designed specifically for generative AI, large language model training, and inference workloads. Unlike broad platforms like AWS or Google Cloud, CoreWeave offers a more tailored service model with high-performance clusters, fast interconnects, and deep integration with Nvidia hardware. This specialization allows it to serve AI-native companies that need massive compute throughput. But it also means the business is highly dependent on two things: the continued availability of high-end Nvidia GPUs and CoreWeave's ability to scale data centers fast enough to meet demand. This niche positioning is a strength, but also a source of operational vulnerability. CoreWeave entered the public markets in March 2025 with an IPO price of around $40 per share, raising about $1.5 billion to accelerate data center expansion. Since then, the stock has been extremely volatile. It recently traded in the low to mid $70 range, comfortably above its post-IPO lows, but far below its 52-week high of nearly $187. This shows just how wide the valuation swings have been. Investors are trying to price in both the massive revenue potential and the ongoing losses as the company scales. CoreWeave remains unprofitable with negative earnings per share, which is expected for a capital-intensive growth company. But it does introduce additional risk. Overall, the stock's range reflects both excitement and caution. In its most recent quarter, Q3 2025, CoreWeave delivered revenue of about $1.36 billion, more than doubling year over year and beating Wall Street expectations. This shows that demand for high-performance AI compute is still extremely strong. However, the company also reported a net loss, reminding investors that the business is still in heavy build-out mode. Despite the strong numbers, the stock sold off because management cut full-year revenue guidance. The main reason wasn't demand, it was execution challenges, specifically delays in data center construction by third-party partners. Those delays limit how fast CoreWeave can onboard new customers. This dynamic highlights the central tension in CoreWeave's story: extraordinary growth potential constrained by the realities of scaling physical infrastructure. CoreWeave has raised enormous amounts of capital over the past few years, well over $1 billion in equity, and multiple multi-billion-dollar debt facilities. These funds support data center construction, GPU procurement, and expansion into new regions. In private markets, CoreWeave was valued between $19 billion and $23 billion before going public, reflecting investor enthusiasm for AI-focused infrastructure providers. But this growth comes at a cost. The company's balance sheet carries substantial leverage, and its capital expenditures remain extremely high. CoreWeave must continue raising financing to keep up with GPU demand and facility buildouts. This financial profile is normal for early stage infrastructure companies, but increases risk. Investors have to monitor liquidity, debt levels, and ongoing funding needs closely. Market sentiment around CoreWeave is mixed but highly engaged. On one hand, some investors believe CoreWeave is emerging as a critical backbone of the AI economy, providing compute capacity that could support multi year revenue and earnings growth. Hedge funds, growth investors, and several institutional managers have taken positions, signaling strong conviction from parts of the market. On the other hand, analysts caution that customer concentration, massive capex, and execution challenges create ongoing volatility. The guidance cut in Q3 only reinforced those concerns. As a result, price targets vary widely, some bullish, some cautious, reflecting uncertainty about how quickly CoreWeave can translate demand into durable profitability. The investment community views it as a high upside but high risk name. CoreWeave represents a classic early stage AI infrastructure investment. Extremely high growth potential paired with equally high uncertainty. Its narrow focus on GPU accelerated workloads positions it well for the generative AI boom, but its business model requires heavy ongoing capital investment. This means cash flow volatility, potential dilution, and sensitivity to supply chain or construction delays. Unlike mature cloud platforms, CoreWeave lacks diversification and depends on rapid expansion to meet demand. For investors, this suggests a measured approach, treating the stock as a speculative, high beta component of a broader portfolio, rather than a core holding. The long term upside could be significant, but it requires patience, risk tolerance, and close attention to execution milestones and financing strategies.